Lehman Brothers suffering a spectacular downfall. Its stock at one point this year sold for $67 a share. Right now it's trading at just $3.65 a share. CNN's Alan Chernoff joins us now.
New York. What a spectacular city, isn't it? Who could thought that one of the most catastrophic events could occur in such a city? Lehman Brothers, Goldman Sachs, Citigroup. They all lived a dream. How did we end up in this? Why couldn't we prevent it? Why not save a gigantic bank and save all of our troubles? In February 2007, Lehman Brothers stocks reached a record of $86.18, bringing up its market capitalization to over $60 billion. Once the fourth largest Wall Street investment bank, with 25,000 employees all around the world, has seen its market capitalization shrink from over 47 to just $5.4 billion. It is just natural to ask ourselves, how did this happen and why? CDOs were the first step to hell. Indeed, these were created to make money on the credit default risk from the people who subscribed to subprime credit. The more the credit is risky, the higher the investment return is. Once the credit default is higher than the initial capital invested, the investor loses all of his initial investment. But as some credits were too much risky and there was no customer to invest in, then financial engineers were wondering, why don't we smash all the credit default risk into a pool of risky subprime credits? Then as several customers can invest in, there will be less risks for higher returns than treasury bonds and better rate from notation agency, and they call it CDOs. So Lehman Brothers bought these products, which seems to be a good investment solution to finally move away the credit default risks on insurance institutions by buying CDS to hedge the positions on CDOs. And these work well, so well that Lehman decided to invest up to 32 times of its own market capitalization in CDOs and CDS to increase its profit. The CDOs machine is in progress until the fall, but when the number of credit default came to be so huge that insurance institutions could finally not honor the deals, Lehman was seeing all its position and its stock price falling down. So the bank found itself with shitty deals in the dealing books, and the bank could not pay back all the money had been borrowed to invest in CDOs. They finally had lack of liabilities until its bankruptcy. John Thain, previous Merrill Lynch CEO, says that Fed should have bailed out Lehman Brothers. The bank was too big to fail. The financial market got worse and extended to the whole banking system. In addition, this bankruptcy created a lack of confidence on the market. Investors were suspicious of the banking system and banks stopped lending money. While confidence in finance sectors and futures is a key on markets, governments do not have to act on the markets. Any weak institution has to disappear to leave reliable actors to make the markets efficient and robust. In that way, Lehman Brothers bankruptcy was a bad player that lost, which would have helped to make the market cleaner. But this idea does not take into account immediate consequences, and if the Fed had followed this way of thinking, the result would have been worse. Ben Bernanke, Fed CEO, chose not to save Lehman Brothers by ethic. If all institution thinks that whatever happens on the market they will be saved by the government, they will not take into account the dangerous positions they take. IAG was saved just after Lehman collapsed. In other words, government wanted to make Lehman fall as an example to the financial system. Bankers should have been responsible to their position held. Lehman bailout was like a bomb waking up all the government to setting up regulations and brought Basel II after November 2008. There were 148 banks fall in 2009 and 157 in 2010. Governments knew that they had to face a global crisis. Letting Lehman Brothers falling made the crisis more important and longer, but even if American government had saved it, it would not have avoided the crisis that was up the year before the bankruptcy.